Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures are wavering after the S&P 500 hit fresh record highs this week, and as a global stock rally that persists right now. China stocks surging today after strong earnings from Alibaba fueled some optimism over artificial intelligence, sending Chinese technology stocks to their highest level since, get this, 2022. In Europe, the Stoxx 600 index is heading for its ninth consecutive weekly gain on the back of resilient profits and optimism over peace talks in Ukraine.
Plus, investors looking ahead to a fresh set of economic data out this morning. The final reading of a University of Michigan's consumer sentiment that will be crossing the wire in just about an hour. The report following a preliminary reading that showed sentiment actually fell to a 7th-month low in early February. That was due to an increased short-term inflation expectations, much of that related to tariff concerns.
And over the weekend, investors will be watching out for Warren Buffett's annual letter to shareholders. The veteran investor known as the Oracle of Omaha will release his letter as well as Berkshire's annual earnings report. With the famed investor's cash piles at record highs, investors will be looking for any clues on his investment outlook after he cut his holdings in Bank of America last quarter and kept his Apple stake intact. Well, good morning. Let's take a look at U.S. stock futures. Right now, mixed. The Dow is down by about 0.5%, but seeing some gains for the S&P 500 and the NASDAQ here this morning after hitting record highs this week. While tariffs and their inflationary impact have been front of mind for investors, Wall Street may not fully be pricing in policy risk from the White House. Here to break it all down, we've got our markets reporter, Josh Schaefer. What more do they need to be considering in that policy risk?
Yeah, Brad, so there's been some interesting growing discussion about, of course, we talk a lot about tariffs because President Trump is talking a lot about tariffs, right? But one thing that has been a little bit underneath the headlines, but is a key part of his policy would be deportation, right? And also limiting immigration into the U.S. And immigration has been a large story of why the U.S. economy outperformed, and we didn't go into a recession when a lot of people were calling for a recession over the last couple of years. There's an interesting note from Michael Gapin, the chief economist over at Morgan Stanley, and what he's pointing out is we were having pacing at immigration of about 3 million per year from 2022 to 2024. Assuming Trump's policies go into effect as expected, immigration would fall to 1 million this year, 500,000 next year. Why does all this matter? The key here being, if immigration falls to that level, it's going to have impacts on the labor market and potentially impacts on inflation. So it would potentially slow growth, slow GDP to perhaps below 2%, continue to slow growth over the next couple of years, and a key inflationary pressure could come up here, which is something you guys recently talked about with Blake Gwynn from RBC. He was pointing out, okay, if you lower your labor force, there's less workers. What do we know about when there's less workers and less overall supply, right? That means that the actual employers are going to have to potentially offer more money. Then we get wage pressures back. That's an inflation problem. So overall, I think the takeaway perhaps here being Trump policy is not going away as a headwind for investors and something to think about. Just because we get tariff headlines and we maybe eventually get clarity on tariffs in the next month, the ongoing policy cloud, if that's what you're worried about, that is not something that is just going to disappear next month or disappear come March, April.
Yeah, Josh, that's a great point. I guess the question for investors is how quickly this could change and how quickly that would then be reflected in some of the data. Obviously, it'd be real time here, but just in terms of the escalation of that and trying to figure out just how broad or how sweeping of a change we're actually going to see from the White House.
It seems like it would be late 2025 you would start to see this in labor market data, which is kind of similar to what you might see from some of the tariffs too, right? And that's sort of why the current narrative is maybe Fed doesn't cut for the first half of the year, wait and see how some of this plays out, and then they potentially cut in the second half of the year. But it also was, again, to bring it back to the conversation you recently had with the strategist, it was one reason why people brought up hikes, right? If this is as bad as it could be and really does put inflationary pressures, it wouldn't pass through in the same way tariffs would. So tariffs would probably be a one-time pass-through cost, right? Those prices go up and they only go up once. If wages reaccelerate and spiral, that wouldn't be a one-time pass-through. That would be an issue that would perhaps start in late 2025, maybe even carry over into 2026, and it would change the Fed narrative a little bit more than currently anticipated. So then that would change probably how you're investing, right? We would be in a little bit of a higher rate environment, if not maybe a hiking environment. We've talked a lot about the Fed easing bias being a key to this market right now. This is one of the risks that could potentially change that. But again, a lot to be seen when it comes to it.
Yeah, certainly the ramifications within the economy. All right, Josh, great stuff. Thanks so much. Let's stick with that and talk about the impact that we could actually see on U.S. stocks as a result of some of the policy coming out of Washington. Right now, we have U.S. stocks trading just shy of the record highs from earlier this week. However, though Citi is warning of near-term downside risk to equities, much of that coming from President Trump's policy effects. Joining us now, we want to bring in Citi's head of U.S. equity strategy, Scott Chronert. Scott, it's great to talk to you again. Thanks so much for making the time to join us here this morning. So talk to me about that downside risk. What does that look like?
Well, Seana, I think, the conversation you just had with Josh sets up, I think, a bigger issue. And that is that as we look at where the S&P is trading currently, 25 times trailing roughly, 22 times forward earnings, near an all-time high, the market has been deservedly focused on Trump policies all told, right? Tariffs gets most of the discussion because of its seemingly more direct impact on fundamentals. But the package in its entirety, combination of tariffs, potential for tax reform, which is probably more of a 26 event. Then you go down the deregulatory path, which is still, I think, to be defined. But then you have this new element, courtesy of Musk and Doge, where you're now focusing on ways to streamline, make the government process more efficient, which essentially means at some point a potential end to the fiscally positive impulse that we've had in place since the pandemic ended. So our point here is that as you look at the starting point, you look at what probably has yet to be priced in from a fundamental perspective. Our view is that there's still upside for the S&P between now and year end, but between here and there is probably an ongoing period of volatility concern that keeps us looking for pullbacks as better buying points.
Okay, so does that positioning, and as you're kind of laying out all of these different issues that investors are watching for, does that mean you should be more broad market focused to try and hedge some of that volatility, or does that mean you should be in a stock picker's mentality, looking for the names that can benefit off of each of these risks that you mentioned?
Well, Brad, the latter for sure, okay? But I think the other element of this, we're talking about macros, and again, the conversation is kind of centered around that. In the meantime, what we're also focused on, which has been written up in our note this week, is that if you look at the Mag 7 component of the market, okay, you're looking at a weight that's, let's call it a third of the S&P index weight. In that case, probably a little bit less sensitive to the broader policy spectrum, probably a little bit less sensitive to the immigration concerns you were talking about. But importantly, on a standalone basis, that part of the market has been showing a decelerating pace of beats and forward guidance raise to expectations. That's an issue. When you're trading at the heady valuation that most of those companies are, our concern becomes that you lose that leadership, which is okay as long as the broadening that we're talking about offsets it. But if you look at the way the years have unfolded so far, you only have one of the Mag 7 actually outperforming. So the broadening is happening, but what I'm saying here is that you need both legs of this to work. You need the broadening effect, which is, I think, a real intrinsic positive for U.S. equity fundamentals, but you also need that Mag 7 to continue to contribute, and that's where we're getting a little bit of pause right now.
Yeah, and Scott, just bringing this back, I guess, to Fed policy, and obviously we have seen this bit of a rotation. There is questions just given the fact that we haven't seen the broader participation from Mag 7, but then coupling that with some of the policy initiatives that you were talking about from Washington earlier this week, where does that leave the Fed? And I guess how tough and how complicated of a decision and of a path forward the committee has at this point, trying to determine what is the appropriate and right timing of that next step?
Yeah, so what we've learned from the Fed, they've been, quote, data dependent for years, it seems like, right? So I don't know that the Fed's going to move in anticipation of Trump policy effects. I certainly wouldn't expect that. I think where consensus is currently for a cut or maybe two as the balance of this year unfolds is appropriate. again, we've talked previously about the S&P pricing in soft landing and Goldilocks. Goldilocks gets upset if you move down a path where the Fed is actually in a position to tighten. I don't think that's the case. We don't think as a house view that as a case, but it's certainly a possibility that we have to keep an eye on. But my point here is that if in the background, I'm a little bit more concerned about aggregate consumption, courtesy of Trump policy and some of the immigration and other measures you talk about, I'm incrementally less concerned about the Fed. So we're okay with a 10-year in this 4.5 range, plus or minus. I think where we get a little bit more nervous is if you see rates back up towards the 5 handle. But again, the countervailing force on that is that you're taking a little bit of pressure off of forward expectations on yields, courtesy of some of the initiatives to look at ways to streamline government spending, which really were not in the policy discussion several months ago.
Scott, let's talk a little bit more just about that risk side of that scenario. If we do see the 10-year yield move back up to that 5% level, I guess what would be the trigger of that potentially?
I think it would have to be this. It would have to be, sort of a shock that you're seeing under the surface. Natural inflation pressures tick back in, and then you combine that with the perceived risk of tariffs. Right now, the tariff discussion is important on this because as the discussion has been out there for several months now, many investors quickly go to, oh, this is an inflationary issue, because the expectation is that corporations will essentially take the tariff cost and pass it through in end prices. We question that. I'm not as concerned, honestly, about inflation as I am with the gross margin risk of companies not being able to pass it through and having to kind of take a gross margin hit in turn. So there's a lot of countervailing forces here, Seana. Very difficult to say how it's specifically going to play out. I think we certainly have to be aware of that tighter for longer Fed narrative. But as we've learned over the past couple of years, a higher Fed, more hawkish Fed policy doesn't have to be necessarily negative for stocks as long as there's a fundamental offset. In the past couple of years, it's been the Mag 7 and the AI push has been that fundamental offset. So, we've got a balancing act here that I think if I'm going to kind of, pull this all together, it kind of comes back to the starting point. What's happening right now in the market, in our view, is that individual stock and industry group activity is where you're seeing the expectations for rates, the expectations for Trump policies to play through. But so far, it hasn't been an all-in index issue.
Scott, thanks so much for taking the time here with us today. Appreciate it.
You bet.
Another asset class we've got our eyes on, safe havens. Gold is heading for an 8th consecutive weekly advance due to robust haven demand fueled by geopolitical and trade tensions. Gold has hit successive records this year after climbing 27% in 2024 amid mounting concerns over President Trump's disruptive trade and geopolitical agendas. The precious metal hit a fresh peak on Thursday amid fears that Trump could unwind American support for Ukraine. Goldman Sachs this week raised its year-end target for the metal to $3,100 an ounce, saying the central bank buying would be a key driver here. Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, a check-in on EVs with Rivian results out and reports Tesla could invest in Nissan. We'll discuss those reports, plus look at where options are pricing in Nvidia's next move with earnings due out in less than a week. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about Rivian this morning, beating fourth quarter expectations and posting its first gross quarterly profit. Still, the electric vehicle maker expects fewer deliveries this year compared to 2024. Joining us now for more on RIVN, we've got Garrett Nelson, who is the CFRA analyst. Garrett, great to have you on the program with us this morning. How are you assessing these results from Rivian and this profitability marker?
Sure. The quarter was a positive. They beat on the bottom line. Was driven by stronger revenue, which came in $300 million above consensus expectations. This was really driven by software and services revenue, which is their agreement, the JV agreement that they recently signed with Volkswagen, which is very high margin revenue stream, and that enabled them to generate a positive gross margin overall of about 10% during the quarter, which is a milestone, having been negative gross margin for some time. So still didn't help them on the bottom line with a profitability, but was a step in the right direction. Now, the negative was the 2025 guidance, and I think that's much more important. Obviously, what they reported for the quarters in the past, the market is forward-looking. The sales guidance that they provided of 46,000 to 51,000 units for the full year actually implies a slight decline from what they sold last year. So I think that's why you're seeing the stock trade down pretty significantly here in the pre-market.
Garrett, what does it tell us a little bit more broadly just about some of that uncertainty stemming from the policies and changes here to incentives?
Well, we think there's a real demand issue here. We've seen EV growth slowing for some time. And, you know, if you're a Rivian and you're producing and selling roughly 50,000 units a year, it is very difficult to compete with a larger automaker such as General Motors or Ford, both of which sold over 2 million vehicles in the US last year. So you think about that, that's over 40 times the volume that Rivian did last year. So, and we're seeing in the marketplace consumers showing a lot of interest in hybrids as opposed to pure battery EVs, which of course Rivian produces. So they're fighting that headwind, and then you have the federal EV tax credit, which we think will be going away later this year when new tax legislation is passed.
You know, elsewhere in the world of EVs, while we have you, Garrett, it seems like there is some type of brouhaha forming, at least in the will they, won't they, in the terms of an investment potentially between Tesla and Nissan. You do have the denial that came out, that is fresh in recent hours as well, that a former board member at Tesla is ultimately kind of pushing back against this FT report here. So all these things considered, what are you anticipating could be the environment for EVs, knowing that you're going to have federal tax credits that get rolled back this year, and then also you have even more of the entrenchment that Tesla is looking to steer forward?
Yeah, no question. It's a difficult environment, especially if you're a small EV startup that maybe went public 3 or 4 years ago. Earlier this week, you saw a bankruptcy filing from Nikola. Last June, you saw Fisker file for bankruptcy. The cash burn rates are just unsustainable for these companies. So it's very difficult. It's a very difficult environment for Rivian, Lucid, and others. As far as the Tesla news, I think this is Nissan would like to do a deal with Tesla. We know that their discussions with Honda reportedly fell through recently. They're in a very difficult spot. They're like a lot of traditional automakers in that they've been losing market share for a long time now, both to Chinese upstart automakers, as well as companies like Tesla, who have grown their volume dramatically over the last few years. So Tesla hasn't indicated any interest in Nissan, but we do think they should take a look at this opportunity. It could make sense for them. A few years ago, they put out a long-term goal of growing their annual volumes to 20 million vehicles sold per year by 2030. That is a very lofty goal. And from our perspective, we just don't understand how they would possibly get there unless they make some acquisitions. Tesla has long showed a preference for greenfields growth, for organic growth, and they haven't done much of the way of acquisitions, the one exception being their Fremont, California factory, which they bought from Toyota in 2010. But this isn't really in their wheelhouse, to do something like this. But we do think it makes sense for them to at least look at everything makes sense at the right price in our view.
Garrett, I think, at least from some of the initial reactions that I'm reading this morning, there's just some questions around the synergies, right? And I guess how quickly Tesla would potentially be able to use some of these Nissan factories. From your assessment, what does that look like? Is that a concern?
We think, reportedly, they're shopping some of their North American plants. And so we do think that makes sense for Tesla. The problem is Tesla really prefers to build from scratch, utilizing the latest in production techniques, robotics, and other methods to really drive down their unit costs and gain a competitive advantage over other automakers. That's what they've done. You've look at the Austin factory, Berlin, Shanghai, the new factory that they're planning to build in Mexico, all greenfields plants. So this would be out of the ordinary for them to buy assets, but we think Nissan is sort of in somewhat of a distressed situation, and we think they could potentially acquire those plants at the right price. So it's something they should look at.
All right, Garrett, great to talk to you. Thanks so much for making the time to join us.
Thank you.
Let's take a look at our second trending ticker here, Yahoo Finance today, and that is UnitedHealth. It's under a bit of pressure here this morning following a report out from the Journal that the Justice Department is investigating the company's Medicare billing practices. Now, when it comes to what the Journal is citing, they're saying that this is a new civil fraud investigation examining UnitedHealthcare's practices for recording diagnoses that trigger extra payments to its Medicare Advantage plans and the patients that come under the Medicare Advantage plan. You're looking at losses right now of just about 11%, nearly a 12% drop here in the pre-market. Now, let's talk a little bit just about the significance of this and this analysis that was done from the Wall Street Journal and why this is so serious and in terms of if this is true, why they would be doing it. Because it actually found that patients examined by UnitedHealth employed doctors had huge increases in lucrative diagnoses after joining the company's Medicare Advantage plans. Why would they do this? Patients that do have certain diagnoses, the payments go up, and that creates an incentive to diagnose more diseases. So that, of course, is what the Journal report is calling out, and that is why you're seeing such a significant reaction here in share prices this morning with the stock off just over 12%.
Yeah, no, spot on. This is something that we've seen administration over administration try to tackle, how the healthcare system has been going after consumers, specifically with some of the phantom billing, with some of the need for consumers to even ask, hey, what am I being billed for here, and get itemized billing so that they can push back on things that get included that don't ultimately need to be listed out or even included within what they're paying for when they go to just make sure that they can get a full Medicare, or not even Medicare, just a medical benefit taken care of in full here. The Department of Justice, they're looking to kind of understand how this company's practices for diagnoses and documenting diagnoses also triggers these extra payments too. So that also part of the Wall Street Journal report, and they're citing people familiar with the matter on this. So we'll continue to see how shares react throughout the rest of today. Finally here, Celsius buying rival energy drink maker Alani Nutrition for $1.8 billion in cash and stock. Alani Nu has positioned itself as a low-calorie fitness aid and has gained popularity through social media influencers. The deal expected to close in the second quarter of this year. Shares of Celsius, they're moving higher by about 34% right now. What they did kind of give in terms of the clarification on this, it sounds like $1.8 billion, $150 million in tax assets for a net purchase price of about $1.65 billion here is what the company is saying as part of this announcement, and combining two growing and scaling brands in the energy drink category here.
Yeah, I think a lot of this has to do with fending off some of that increased competition. It's something that analysts have brought up time and time again. Jefferies was out saying that some of the new sugar-free offerings from Red Bull is only going to add to that competitive landscape here in the coming years. Ahead of this report, though, you are looking at a 34% jump here in pre-market. The stock was off about 70% from its peak just about a year ago. So certainly under a tremendous amount of pressure as investors, as analysts try to work through the slowing growth that we certainly have seen at Celsius. So this is an effort here to regain some of that lost momentum. We will see whether or not that is done. But again, it has posted year-over-year declines in the past 2 quarters when it comes to revenue. It's trying to do all it can to regain some of that lost sale momentum, which has slowed. We'll see whether or not this gets it done. I've never had.
Really?
No, Alani Nu Nutrition. No, I've never had.
Oh, Alani Nu.
Yeah.
Okay. Have you had a Celsius?
Yeah, of course.
Oh, my bad.
Of course. It's a staple around here at Yahoo Finance. I feel like someone's always offering one. It says a lot about us. All right, we're going to go to break, but when we come back, we've got the opening bell coming up next. Just about a few seconds here until the opening bell rings on Wall Street as we kick off the final trading day of the week. Let's take a look at where things are set to open. Again, it has been a little bit of a mixed action here in pre-market trading as investors digest more earnings that were out ahead of the bell and after the bell last night. And of course, square that off with some of the policy initiatives coming out of Washington. S&P hitting a record high earlier this week. We did see a bit of a pullback there. But again, when you take a look at where things are opening today here, it looks like we are going to see a bit of a mixed picture as things do calibrate here. You've got the Dow off just about 0.6%. The S&P actually back in negative territory right now, opening up lower by a fraction. You've also got the NASDAQ, it looks like, under just a bit of pressure today. It's also important to take a close look at the bond market and some of the reaction that we have seen there. We're just below that 4.5 level. Again, a move lower here of just about 1 basis point. But again, good to keep in mind, actually, the NASDAQ opened higher here. You're looking at gains of just about 0.2%. When you take a look at some of the sector action here this morning on an intraday basis, you got communication services, consumer discretionary among the leaders here this morning, followed by financials. On the flip side, healthcare is off just about 1%. A lot of that has to do probably with the fall in UnitedHealth. Taking a look at a 5-day chart here, what we have seen here so far this week, you're looking at energy among the gainers for a day because it's actually a holiday shortened week here. But again, energy an outperformer here as of late. You've also got utilities here moving to the upside. Real estate among the outperformers here today. Consumer discretionary lagging behind. Let's kick it over to Jared Blick, a closer look at some of the movement that we're seeing. Jared.
Yeah, Seana, thank you. Well, we got to talk about the indices first. And in a bull market, the index volatility shrinks. And so it's supposed to be somewhat boring. I'm going to put on a 4-day chart and we're going to see, well, hopefully, let's try the S&P 500. S&P 500 basically flat on the week. NASDAQ right there with it in positive territory today, but just kind of fluctuating not too far from the unchanged line. So not a lot happening. And yesterday, the NASDAQ and the S&P 500 had their worst day in 2 weeks, but it was not a disaster. It's just kind of reminiscent of the fact that we do have this lower volatility in this bull market. Not a lot happening with the dollar or the 10-year T-note yield, so we're going to move on to the sector action where Seana was just talking about some of the week's leaders. Energy and healthcare were the leaders coming into yesterday. Healthcare taking a bit of a dip today, as Seana noted. I do want to point out some of the things happening with the Mag 7. So we're going to look at our leaderboard here, and let's get the MAGS ETF up, and we're going to see that they have been consolidating in a pretty strong pennant formation for a couple of months here. So I'm going to put on a 3-month chart, and hopefully that gives us a picture. Basically, it's going to look like this. We'd have a consolidation, and we're looking for a breakout to the upside or the downside. You're just going to have to take my word on that one. Let's switch over to the NASDAQ 100. This is, again, a 4-day look. So this is what happened this week. Meta having its worst week since December, yet it is still the only Mag 7 name that is appreciably contributing to S&P 500 gains this year. This is a year-long look. You can see Meta up 20%. Really everything else trailing it by quite a large degree. So enough on Meta. I want to tackle Apple, which if it closes in the green today, that will be 8 of 9 days to the upside. And it was only last month that it bounced off the 200-day moving average, which I'm drawing in here. It's just a rough representation, but it bounced off the 200-day, and now it's back up to the decision area. Are the shorts going to reload here, or are they going to get squeezed out? And then it would be a quick trip to highs and maybe even higher from then on, but that's looking pretty far ahead here. Want to also check in on Amazon. Haven't looked at this stock in a while. It was about to snap a 4-day losing streak, but it looks like they're going to add on to it today if they stay in the red. So that's down about 3% this week. And now let's take a look at the chip stocks, because I was looking at the year-to-date, well, I was looking at the weekly totals here. Supermicro and Microchip, they are leading the S&P 500 this week. So let's see if we can find Microchip or SMCI. There we go. This small square is 4% today. Over the last 4 days, that's 28.76%. And here's a longer-term chart so you can remember where we came from. They were added to the S&P 500 right at the top, saw this significant decline, and now we're bouncing off of these lows here. So that's the story with SMCI. And here's Microchip microchip 5-year chart, and kind of a similar story there. It wasn't added to the S&P 500 at the same time, but it did see that significant decline, and now it's trying to climb out of that hole. I'm going to close it there because I didn't really see anything notable happening in either futures or Bitcoin. So on that note, Brad, I send it back to you.
That's fair, Jared. You've done so much already. We appreciate it.
Thank you.
Nvidia reports fourth quarter earnings after the closing bell on Wednesday, February 26th. Catalyst co-host Madison Mills joins us now for a look at the 4 things that she's watching. Hey, Maddie.
Hey, Brad, that's right. We're watching supply and demand dynamics, any color on policy impact from export controls to tariffs, and forward guidance, which could include comments on the Blackwell chip and DeepSeek competition. So let's break these down. Starting it off with supply versus demand. We've seen Microsoft, Google, and Amazon missing on revenue expectations in part due to lack of supply. They didn't have the capacity to meet strong customer demand. Will the same be true for Nvidia? The street is looking for nearly $40 billion in revenue. That number would be hard for Nvidia to hit if they can't meet customer demand for the quarter. Next up, you're looking at dynamics with China and export controls. The Biden administration had already restricted Nvidia's AI chips from being sold to China. The Trump administration has signaled an interest in furthering those export controls in order to boost domestic chips production, especially after DeepSeek said that they had used Nvidia's chips to train their cheaper AI model. Another policy to watch here, tariffs on chips. President Trump had teased out a potential 25% tariffs on chips this week. That could be a problem for Nvidia because the company obviously dominates in AI, but there are lower cost alternatives. So if tariffs increase the cost of Nvidia chips, they have a choice. Customers, would they pay up or would Nvidia eat those costs? And if they do, that could put pressure on their profit margins. Lastly, we're looking at forward guidance and the success of Blackwell. Investors want to know when Nvidia's next-gen Blackwell chips will take over as the dominant driver of revenue in their data center business, because that could drive guidance higher due to the high cost of Blackwell chips. And that guidance could also include commentary on that DeepSeek competition, that DeepSeek market drop that happened just before the other big tech earnings. Nvidia has had a lot more time to prepare a thesis around that than the other big tech names. So will we get that thesis around DeepSeek? That'll be a big question, and we will see answers to hopefully all of these on February 26th.
All right, thanks so much, Maddie. Let's continue the conversation about Nvidia. Nvidia earnings out Wednesday, February 26th, like Maddie just said. After the bell, options implied volatility signaling potentially a more modest reaction than what we have seen as of late. When you take a look at the fact that maybe now there's questions about how important this is to the overall impact of the market. Joining us now, we want to bring in David Boole. He's the Baycrest Managing Director, Equity Derivatives. David, it's great to talk to you again. So talk to me just about the size of this reaction. What should we be expecting?
Well, like you said, options are expecting about a 7% move, which is a little bit less than what options have expected in previous earnings reports over the last 2 years. And exactly, I'm wondering aloud if this singular report, which used to be a massive focus for the market, just matters a little bit less than it used to. Now, I'm looking back at the last 3 times NVIDIA reported earnings. QQQ, the NASDAQ ETF, was about flat that day. If you go back to the end of 2023, early 2024, Qs were up or down 2% 3 out of the 4 times that NVIDIA reported those times. Lately, it just hasn't been driving the overall market action as much as it used to. And then specifically for NVIDIA, this 7% implied move is a lot. That's like $240 billion of market cap that are expected to be created or destroyed. But NVIDIA is such a overall volatile stock that's only about double or 2.5 times as much as it's supposed to move on a normal trading day. So it's a big event, but I'm starting to think that it might not be a one-day surge like it used to if you go back 1.5, 2 years, but it might really set the stage for what the next month is going to look at. So I'm looking at this as a 1-month event, essentially, not really just the one-day jump move this time around.
And so with that in mind, what do you think is the core driver of that move here? Is it demand? Is it ultimately saying, you know what, DeepSeek's not an issue and we're still a beneficiary, even if DeepSeek or other language learning models out there are successful? What is it from your analysis?
To me, the setup, it coincides with what I just said. Maybe it's more of a muted reaction because we already tested the low on this DeepSeek news. We had the dress rehearsal about a month ago or 3 weeks ago, where we saw what happens if the stock goes down 17%. Well, we saw the dip buyers step in size. There were some put buyers that came in to hedge those positions, but anybody that was feeling a little bit wishy-washy about potential gains they're sitting on in the Nvidia stock, they had the chance to hit bids on that day that moved lower, and then new buyers stepped in. So the setup I'm seeing from clients is that it's certainly less overowned than it was over the last 2 years. The numbers are likely to be pretty strong, but how good could it be with the rest of their major customers already reporting big CapEx numbers? I think the sense is, what can they say that's going to really drive Nvidia up another 20% in one day? But if anything, this could be an overhang removed, and the stock could then grind higher over the next couple weeks or a month.
So, David, what's your trade idea off the back of this?
So, as I'm saying, I don't think it's going to be a huge one-day move. Options are still have that memory of it moving a ton over the last 2 years in one day. So I like playing for the stock to grind higher. And so the trade that I would put on is a call fly. It sounds fancy, but the point of this trade is to risk a limited amount of premium. I don't want to have an open-ended max loss on this position. So in this specific example, I would buy the March 150, 160, 170 call fly. And so what I'm doing is I'm buying one of the March 150 calls, selling two of the March 160 calls, buying back one of the March 170 calls. The whole idea is play the stock drifting higher. The one-day theta burn of the stock, how much does it cost to carry it, is almost flat. For instance, if you buy a call for $5 or $10, every day that it doesn't surge higher, you're going to lose a little bit of money. But if you structure it where you're buying and selling the same amount of options, then it's not going to decay over time as much. So that gives me time for the stock to drift higher. And then it's about a 50% implied vol stock. So that's expected to move up about 15% per month, which it has last February and March. It's been a very strong seasonal period for Nvidia. So I like to play it grinding higher. And if it does grind higher 15% over the next month, I can still make an explosive return up almost 10 times my money in that period if it pins at 160.
David, I'm curious how you looked at the volatility that we saw just a few weeks ago with the developments of DeepSeek and really the volatility that sparked or triggered across the AI trading spectrum. Put that in perspective for us just in terms of, I guess, the likelihood, the hedging that maybe investors should be keeping in mind as we do get more and more developments just about how advanced some of this new technology is.
Well, we saw the dip buyer step in the stock, and the whole makeup of the options, which I look at closely, it's investors aren't the whole narrative that investors were buying calls and that was the tail of the dog pushing the stock higher. That doesn't seem to be the case from the flows that I'm seeing. A lot of investors seem to be long the stock, happily long the stock, and selling calls to extract income and selling puts to extract income. So there's a lot of clients that are betting on the stock to stay somewhat range bound. It's all relative. If Nvidia is bouncing between 120 and 150, that's a big move for any other stock. But for Nvidia, that's still a pretty modest range. And so investors have been selling options, and that helps kind of self-perpetuate the stock staying in a tighter range. We've now had, today might be the fourth, we've now had 3 days in a row. Today could be the fourth where the stock hasn't moved more than 1% in either direction. That hasn't happened since 2023. So anybody that's thinking about hedging the downside, I would also argue for spreads on the downside. Buy a put spread to limit the amount of premium you're spending on an option in case it is a very modest move. And also, in my opinion, we've proven that there are dip buyers that want to step in down at that 120, 115 level. So I would be looking at spreads on both sides, up and down.
David, thank you so much for taking the time. Appreciate it.
Thanks.
We will have special coverage of NVIDIA's fourth quarter earnings report Wednesday, February 26th, starting at 4 p.m. Eastern Time on Yahoo Finance. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief.
The U.S. dollar index seeing a 5% rally from President Trump's election up until his inauguration. But since then, the greenback has fallen about 1% as investors ditch America First wagers amid growing trade tensions and inflation concerns. Now there's some growing chatter on Wall Street about a so-called Mar-a-Lago Accord as Trump's nominee to lead the White House Council of Economic Advisors laid out a roadmap for reforming the global trading system and weeding out economic imbalances driven by, quote, persistent dollar overvaluation. Let's talk about this and more. We want to bring in Sandra Martin, the head of monetary policy and FX research at DZ Bank. It's great to have you back here on Yahoo Finance. So talk to me just about what this all spells out here for the dollar and some of that momentum that maybe could be lost or regained here in the weeks to come.
Well, obviously, we've had a really tough month since Trump moved back into the White House. There's been, decrees being signed. It's been, tariffs announced and delayed. And, it's really difficult to look through the very confused messaging we've been getting here. The latest news, obviously, as you just mentioned, the Mar-a-Lago Accord, the idea that, you have a concerted action to prevent the overvaluation of the dollar. At the same time, the U.S. has confirmed that it stands by its strong dollar policy. So again, it's a lot of confusion. And I think when you look at the market reaction, there's been some movement, but I think investors are really, really struggling to see clear headway here because they're trying to figure out, on one side, the possible economic impact of Trump's policies. So we're talking tariffs, we're talking immigration policy, etc. And on the other hand, obviously trying to figure out which things they even should be taken into consideration, because of course with Trump, you never quite know what you're going to get in the end. So there's a lot of confusion in the market right now. I think there are people who are starting to get more bearish on the US dollar, and I can understand that given what's happening. But I'm not quite ready to throw the towel because I still do believe that tariffs will come, and when they do, they will have a positive impact on the dollar.
What's the reaction that we saw last time? Because in Trump 1.0, we had tariffs, and a lot of economists, a lot of investment strategists were saying going into the election, hey, they can just dust off their tariff playbook from Trump 1.0 and potentially apply that here. So what did we see that first time, and then how much of that can be mirrored or perhaps the same play run this time?
I think it's quite different, to be honest, because first time around, the tariffs came quite late in the presidency. So that's not something he started off with. So there was a couple of years almost that went by until we got the full tariff story. So this time around, it's been an issue from the get-go. The other thing is that we're talking a level of tariffs that is going to be potentially much higher than what we saw during the first presidency. I mean, looking at China, for example, the tariffs have already been increased. We're now 30%. It looks likely that that's going to go up to 40%. That's a lot more than we had first time around. So I think it's difficult to compare those two scenarios. And my general feeling is that Trump is a lot more aggressive this time around. I mean, he's really, setting out a really quick pace here. So I think we have a much more determined Trump to deal with currently. And then also there is the fact that next to tariff policies and domestic policies like, reducing people in the administration, immigration policies, we also have the whole geopolitical context that's going on. So it's much more difficult this time around, I think, for investors to see clearly ahead. And I think 2016 and the years after that isn't a great playbook to sort of mirror from.
Are we seeing too much complacency in the markets, do you think, Sandra?
Yeah, I think so. I think, especially when it comes to tariffs, I think a lot of people presume, Trump, he barks, but he won't bite. And obviously, I can understand how people come to that conclusion because, he made this massive announcement a couple of weeks ago, 25% on all goods from Mexico and Canada. And then that same evening, he basically said, oh, well, let's give it another month and then we see how we go. I can understand how that leads people to the conclusion that nothing is going to happen. I do think that is highly unlikely. I think there will be tariffs. He has this very strong view about trade policy. So I think the market is underestimating and underpricing this risk.
Sandra, we're going to have to leave it there. Thanks so much for taking the time with us. We appreciate it.
Thanks.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief.
Well, I think he's just knee-deep in the value trade. I mean, he just does not care about some of the broader things that are happening in AI or what have you. They're looking at staples. They're looking at things that people use every day.
That was Lee Munson, President and Chief Investment Officer of Portfolio Wealth Advisors, talking to us about Warren Buffett's investment strategy and what goes into some of his top bets. Well, there's very few investors that command as much attention as Warren Buffett, if any. So actually, let's take a look at the top 5 holdings in Berkshire Hathaway's portfolio. It's the companies that the Oracle of Omaha has been betting big on. And these 5 companies, they account for about 71% of Berkshire's entire portfolio. So let's break them down. Now, maybe no surprise that Apple is at the top spot there, the number 1 spot there. Now, Buffett has famously called the tech giant, quote, the best business that he knows. It accounts for just 28% of Berkshire's portfolio. And I say just because that's actually down from 50% a year ago. Despite recent selling, Buffett has said that he does remain confident in Apple. At the May's shareholder meeting just about a year ago, he said that it was a better business than two of the firm's oldest and largest holdings, American Express and Coca-Cola. Speaking of American Express, that is actually the number 2 holding here for Berkshire Hathaway. Makes up about 17% of the company's portfolio. Now, Buffett's been a longtime believer in the company, first buying shares in the 1960s. Amex CEO Stephen Squeri once told Yahoo Finance, quote, "He gets that the Amex brand is special. He tells me that all the time." Next up, Bank of America. Yes, Buffett has trimmed his position by about a third since July, but at 11% of the portfolio, it's no small bet. He first invested in Bank of America back in 2011 when he bought $5 billion worth of its preferred stock. And rounding out the top 5, we've got Coca-Cola and Chevron. Now, Coca-Cola, it's a classic Warren Buffett favorite. It's a stock that he's been betting on now for over 3 decades. And his love for the brand, well, goes well beyond the balance sheet of Coca-Cola. He reportedly drinks up to 5 cans of Cokes a day. It's a true testament to his belief in the product. And at number 5 is Chevron, accounting for about 6% of the company's portfolio. Chevron has been a holding of Buffett's since the third quarter of 2020. Now, the conglomerate currently owns 118 million shares. That's down from a peak of about 170 million back in 2022. Keep it right here on Yahoo Finance. That does it for Morning Brief. Catalyst is up next. Three, two, one. That was Lee Munson, President and Chief Investment Officer of Portfolio Wealth Advisors, talking about Warren Buffett's investment strategy. Well, few investors, if any, command as much attention as Warren Buffett. So let's take a look at the top 5 holdings in Berkshire Hathaway's portfolio. The companies that the Oracle of Omaha is betting big on. And these 5 companies, they account for about 71% of Berkshire's entire portfolio. So let's break them all down. Now, in the top spot there is Apple. It might be no surprise there that they once again remain at the top spot. Buffett famously called the tech giant, quote, the best business that he knows. It accounts for just 28% of Berkshire's portfolio. And I say just because that's down from 50% a year ago. Despite some of that recent selling, Buffett has said that he does remain confident in Apple. At last May's shareholder meeting, he said that it was a better business than two of the firm's oldest and largest holdings, American Express and Coca-Cola. Well, speaking of American Express, that's now the firm's second largest holding, making up 17% of its portfolio. Buffett's been a longtime believer in the company, first buying shares back in the 1960s. Now, Amex CEO Stephen Squeri once told Yahoo Finance, quote, he gets that the Amex brand is special. He tells me that all the time. Next up is Bank of America. Yes, Warren Buffett has been trimming his position by about a third since July, but at 11% of the portfolio, it's no small bet. He first invested in Bank of America back in 2011. That's when he bought $5 billion worth of its preferred stock. Rounding out the top 5, we've got Coca-Cola and Chevron. Now, Coca-Cola is a classic Buffett favorite. It's a stock that he's been betting on now for over 3 decades. His love for the brand, it goes well beyond the balance sheet. Buffett reportedly drinks up to 5 cans of Coke a day. It's a true testament to his belief in the product. And at number 5, we got Chevron, accounting for about 6% of the portfolio. Chevron has been a holding of Buffett's since the third quarter of 2020. The conglomerate currently owns 118 million shares. That's down from a peak of about $170 million back in 2022.